The factories along the Gastonia-Spartanburg line, once saturated with the scent of cotton dust, had pinned their hopes on a revival, thanks to new customs tariffs. But that optimism is now unraveling. The 25% additional tax, far from shielding local yarn producers, has left them less competitive than ever. The reason? Rising input costs and an unforgiving global supply chain. When you factor in cotton prices, energy bills, financing interest rates, and labor availability, the math is brutally clear. Chinese mills still win, and so the price of American-made t-shirts is climbing. Brands under pressure are shifting sourcing to free trade zones in Ningbo and Yantian. While Carolina's looms sit idle, we need to ask, why are protectionist policies pushing capital eastward? How is a 25% textile tariff triggering capital flight from the American South to the Chinese coast? Let's unpack the numbers and explore what they reveal about a global supply chain reshaping itself under political pressure. Once the Textile Corridor from Gastonia, North Carolina to Spartanburg, South Carolina was an industrial powerhouse. But over the last 15 years, this landscape transformed. A mosaic of boutique denim makers, medical fabric startups, and vertically integrated yarn processors rose from its ashes. They worked fast, they worked lean, but they were always playing catch-up with China's scale. Now, the newly announced 25% tax on imported cut-and-sewn garments has flipped the script. What was meant to protect domestic producers is now functioning like a locked gate, trapping them in an inflationary cost spiral. This rule, introduced with the hope of restoring U.S. fiber production, may unintentionally drive investment away from North Carolina to the Pearl River Delta. In late June, executives from an Oregon-based sportswear giant, a Tennessee workwear brand, and a legacy shirt maker in New England held calls with shipping firms. The topic? Logistics out of China's expanded trade zones, Ningbo, Qingdao, and Xiamen. Their logic is straightforward. If costs are rising, cut somewhere. And if margins can't absorb tariffs, exit the U.S. production cycle altogether. Let's put numbers to this. If a retail chain purchases a cotton polo from El Salvador at $4.40 FOB, the tariff bumps that to $5.50. But consumers are only willing to absorb a 75-cent increase in retail price. That leaves a 35-cent shortfall per shirt. Multiply that by 72 million units a year. That's not just unsustainable, it's corporate suicide. The solution? Move production to Shenzhen. Even with fuel surcharges, costs fall dramatically. But what about speed? Isn't China slower? Not anymore. A container loaded in Yantian on Saturday can reach the port of Long Beach in 19 days. With rail, it's in the Midwest in 4 more. That's only 6 to 7 days slower than domestic rail via Houston. Thanks to better forecasting and regional distribution, those few days don't matter anymore. Currency plays a role too. In April, the yuan dropped below 7.35 against the dollar, the lowest level in 7 years. Treasury teams at major retailers moved quickly. With invoices now cheaper to convert, U.S.-based brands gained a 20 basis point hedge advantage almost overnight. Meanwhile, U.S. factories in Greenville are paying natural gas in dollars and borrowing from domestic lenders at interest rates more than 2.75% above prime. This makes a difference, especially for mid-sized producers running on tight margins. All right, let's dive into capital costs, which really add another layer to the whole equation. Now, those Airjet looms that were purchased back in 2018 under 7-year leases, well, they now need refinancing, and the kicker is that the interest rates are a whopping 15% higher than they were before. In contrast, Chinese provinces are stepping in with loans at half those rates, and they're backed by local municipal bonds. To put that into perspective, a $9 million factory with 300 looms in China pays less in financing than what an American facility dishes out just in annual property taxes. And when we look at environmental upgrades, the gap widens even more. Installing ozone-based bleaching drums to meet California's formaldehyde regulations, that sets you back over $9 million. Meanwhile, Chinese plants built in 2022 already comply because those standards were baked into their designs from day one. Now let's talk about labor, which is also shifting quite a bit. Community colleges in North Carolina are reporting that only 42% of textile tech graduates are actually heading into factory jobs. Many are choosing fields like CNC machining or pharma assembly instead, where the pay is better and the work is cleaner. In rural areas still grappling with opioid absenteeism, staffing those night shifts is becoming nearly impossible. On the other hand, in China, dormitory labor is still legal and quite widespread. It's 12 hours on, 12 hours off. Brutal, sure, but predictable. Compliance now hinges on passing ILO inspections, rather than dealing with high worker turnover. With more labor density and lower churn, Chinese plants manage to stay on schedule, even when they're under volume pressure. And here's a lesser-known problem that's cropping up: the rules of origin. The latest USTR guidance says that unless a garment contains at least 85% domestic yarn, it won't qualify for reduced tariffs, even if it's sewn right here in the US. The thing is, polyester, which is widely used in activewear, is mostly imported from Taiwan or China. So what that means is your average yoga pants or moisture-wicking t-shirt won't qualify, forcing brands to pay full tariffs anyway. So, what's the rational business response to all this? Well, it's to move the whole production process, fiber, yarn, sewing, outside the tariff zone. This way, businesses keep control, lower their risk, and protect their margins. Still, White House officials insist the tariffs are worth the pain. They point to the 2018 steel tariffs as a precedent. Whirlpool reopened its Clyde, Ohio factory. MAGA hats were proudly made in America. But textile CEOs haven't forgotten what happened next. Suppliers raised prices, the dollar surged, and imports came flooding back. That cycle is still fresh in boardrooms. In June, the CFO of a major Oregon-based brand admitted it was, looking east. Meanwhile, a Tennessee workwear company filed an SEC disclosure confirming, and I quote, significant overseas capital expenditures. The market responded instantly. The stock jumped 8%. Why? Because shareholders now view tariffs not as protection, but as permission to abandon aging U.S. production lines. This ripple is spreading beyond cotton. After a petrochemical plant in Louisiana shut down, U.S. nylon filament prices spiked by 15%. But China's overcapacity kept their domestic prices 8 cents per pound lower. And the price of benzene-derived dyes in the U.S. has jumped 80%, while China's massive peroxylene chain is still running at full capacity. Every input ledger is pointing in one direction, east. What about shipping? It's no longer the post-pandemic bottleneck. Spot rates from Shanghai to Los Angeles are now steady at $3,000 per container. That's higher than pre-COVID levels, but not high enough to offset China's cost advantage. And westbound ships often return empty. If U.S. textile exports collapse, shipping firms will simply reload with LNG, scrap paper, or sorghum. ESG compliance was once America's last card. Not anymore. Chinese industrial groups burned by Xinjiang allegations in 2021 now offer blockchain-based traceability. Buyers can scan a QR code and see chemical batch numbers, operator IDs, and wastewater pH. In Carolina, most factories still use barcoded packing slips and plastic sleeves. In a compliance war, the winner is the one who modernized, not the one who means well. Politically, it's a mess. Workers in Kings Mountain just unfurled a banner that read "Customs duties for whom?" Even supportive mayors are backpedaling, drawing lines between strategic tariffs and crude surcharge programs. National security advocates still defend the policy. Aramid fabric for fighter jets is woven in South Carolina. It must stay local. But here's the contradiction. Aramid needs precursor chemicals from Shandong. Raise tariffs, and you also raise defense costs. Mexico sees an opening. Tariff exemptions for North American fiber exist, but they're capped by quotas. That quota only covers part of historical flows. Maquiladora boards want more. They're lobbying for new quotas, like the sugar deal in earlier trade rounds. So far, Washington isn't listening. Not in an election year. Back in China, the provincial tone is calm, but also quite calculated. Officials in Shandong, Hebei, and Fujian are rolling out these 5-year land deals, VAT refunds, subsidized worker housing, and, no import taxes on U.S. cotton. The message is quiet but clear. Let us tariffs hurt you. We'll make sure they don't hurt us. Private equity is watching closely. If cost savings in Asia exceed shipping costs by 10%, they'll move. And right now, they do. Pension funds burned by the last textile collapse won't invest in Carolina again. Venture capital may chase bio-based fibers in California, but that's not fleece or bulk jersey. The mainstream apparel industry wants one thing: the cheapest path to scale. and tariffs are shifting that path to the Pacific. Policy architects in D.C. can talk tough about Beijing, but fashion executives answer to quarterly earnings, and those earnings models? They're recalculated every morning, and they all point east. Unless Washington offers more than penalties, like tax credits, interest-free bonds, and housing subsidies for American workers, the math will keep pushing capital outward. Tariffs may sound strong, but spreadsheets speak louder. Here's the irony. A punitive tariff meant to weaken a geopolitical rival may just deepen your dependency on its industrial system. Cotton grown in Texas can be dyed in China, sewn into a sweatshirt, shipped to Los Angeles, pay the tariff, and still undercut a domestic hoodie made 70 miles from the loom. The cargo moves, the jobs don't, and the loom doesn't stop with a bang. It stops with the quiet click of a spreadsheet cell turning to zero. So, what's your take? Are tariffs helping or hurting? Leave your thoughts in the comments below. And hey, don't forget to subscribe and turn on notifications to stay updated on our future breakdowns.